Now, this particular session is on Action 1, right, which relates to the digital economy and its taxation, and whether Action 1 has any impact on transfer pricing. Now, the arm's length principle has been a mainstay of international tax policy for decades, but its future is going to be shaped by Action 1 of the OECD BEPS Action Plan. Now, as part of its work on taxation and the digital economy, the OECD continues to consult on revising profit allocation and nexus rules. And with businesses in all sectors becoming increasingly digital, the OECD's work could dramatically affect current transfer pricing arrangements. And for me, the question is how? Now, under the arm's length principle, group companies, and you have seen this over the course of the days, group companies aim to set their intercompany transfer prices at the same levels as unrelated parties. The arm's length principle considers the functions, assets, and risks of the parties to the transaction in determining the arm's length pricing. Now, before the OECD initiated its action plan on base erosion and profit shifting, many countries were concerned that companies were able to apply the arm's length principle in a way that allowed them to move profits to no or low tax jurisdictions, based largely on legal ownership, contractual rights, and funding, particularly for intangible property. However, when the issue was debated during the first round of the BEPS talks, the OECD concluded that the arm's length standard itself was not a problem. Rather, the problem was with how the standard was interpreted and implemented in highly complex international arrangements. So now the OECD's BEPS project for taxation states that taxation should be aligned with a transaction's economic reality rather than strictly focusing on the transaction's legal and contractual terms. Now, this has implications for intangibles, which are a focus of both transfer pricing and digital taxation. The revised OECD transfer pricing guidelines for multinational enterprises, these guidelines state that if an entity only has the legal ownership of an intangible asset and not the economic ownership, then that entity should only receive a limited amount of remuneration for its legal ownership. Now, the residual profit resulting from that intangible asset, on the other hand, should be allocated to the intangible asset's economic owner. To determine whether an entity has economic ownership of an intangible asset, right? And I focus on intangible assets because Action 1 relates to intangible assets. So under transfer pricing, to determine whether an entity has economic ownership of an intangible asset, the OECD guidelines prescribe that it should be delineated whether an entity performs the so-called DEMPE functions, which you discussed, or Pim had a discussion of DEMPE with you yesterday. So DEMPE, just to repeat, stands for development, enhancement, maintenance, protection, and exploitation. There are three factors to consider when determining who is performing what function, and these are control, funding, and risk. So per DEMPE function, it should be determined who has control, who is funding, and who is incurring the risks related to the function. This is all about figuring out value creation as part of applying digital taxation under Action 1. Now, the determination of the functions performed and the consideration of the factors are combined in a DEMPE analysis. Such a DEMPE analysis should be prepared on a case-by-case basis and should be substantiated by objective documents such as, annual reports, board meeting notes, and any other internal documents that could provide further substantiation. Now, after having performed a DEMPE analysis, it can then be determined which entity is entitled to the profits resulting from an intangible asset. Now, if the entity is a digital corporate with software as its intangible asset, then transfer pricing assessment must take into account the Pillar 1 proposal on digital taxation under BEPS Action 1. However, it can also be argued based on these OECD guidelines that where you have multiple entities that perform considerable DEMPE functions, in that case, multiple entities are entitled to the profits resulting from an intangible asset. So when this happens, where you have multiple entities which are related to a group, related parties, and they're also performing a DEMPE function or DEMPE analysis, how do they allocate profit between themselves based on this DEMPE analysis? The OECD guidelines set out that the profit split method is the most appropriate method for allocating the profits in such circumstances. Now, where the development or enhancement of an intangible asset is the function of brick and mortar companies, companies which have a physical office or a physical location in a jurisdiction. But its protection and exploitation, in other words, the protection and exploitation of the intangible asset is done through a related digital company, then the profit split method must also factor in profit assessments made using amount A and amount B under Pillar 1. Now, ladies and gentlemen, this is highly complex and technical stuff. The complexity is brought about by the fact that when the OECD was discussing actions 8 to 10 on transfer pricing, it had delayed work on Action 1 on taxing the digital economy. So the discussions on digital tax and its impact on transfer pricing by related digital corporations, such as Meta, which consists of Facebook, Instagram, WhatsApp, were not informed concurrently by the proposals being made under Action 1 and Actions 8 and 10. Now, when the OECD is tackling digital taxation under BEPS 2.0, it is still to address questions about taxing economic activity conducted electronically or digitally with no physical presence and how that affects transfer pricing. Action 1 clearly has implications for transfer pricing. The area that will be subject to Action 1 proposals is DEMPE analysis, which should be assessed also per Action 1's pillar approaches. Now, in January 2019, the OECD issued a policy note proposing to approach these issues through 2 pillars. The first pillar goes beyond the arm's length principle to address nexus and profit allocation issues in the context of digital business activity. The second pillar addresses broader BEPS issues, and it may result in an international minimum taxation framework of some form. Now, allocating profits is the key focus of the first pillar. Before the BEPS action plan, it was not uncommon for a substantial amount of a group's profit to be taxable in no or low tax jurisdictions based on contracts and IP ownership. Then, under the concepts developed in the BEPS action plan, which is now commonly called BEPS 1.0, because 2.0 is for digital taxation, under 1.0 BEPS, profit allocations came to be increasingly aligned with DEMPE, with more earnings taxed in countries with more decision-making substance. BEPS 2.0 will likely attribute more value from remote business activity to the markets involved, allocating a larger share of profits based on the customer base in various locations. And this will be essential to determine transfer pricing between related remote-based corporations. Now, for the assessment of transfer pricing and profit allocation between related companies to be captured under Action 1, the Pillar 1 and 2 requirements must be fulfilled. Okay. Pillar 1 actually offers market jurisdictions new taxing rights over multinationals with over $20 billion annual operating revenue. That's what OPRE stands for, whether or not they have a physical presence in their jurisdiction. And then 25% of the residual profits of the largest 100 in-scope multinationals would be reallocated to tax jurisdictions where their users and customers are located. This is what is referred to as Amount A under Pillar 1. There is also an Amount B, which is a fixed allocation of profit to market jurisdictions using an arm's length principle to arrive at an in-country baseline for marketing and distribution activities. And then we have Pillar 2's scope, which also has to be fulfilled if in assessing transfer pricing, any part of Action 1 on the digital taxation, be it Amount A or Amount B or Pillar 1, Pillar 2, have to be incorporated. So Pillar 2's scope is to extend beyond the traditionally digital businesses to capture multinationals with an annual operating revenue of greater than 750 million euros and those that have a foreign entity presence in their group structure. The aim is to ensure that these in-scope multinationals pay at least a minimum tax of 15%. Again, this is important for the assessment of transfer pricing. The tax rules here are highly complex, consisting of two interlocking domestic rules together with a treaty-based rule. So how we're going to overcome that, it is subject to OECD's further deliberations. Suffice to say that it would be challenging for multinationals to provide and for tax administrations to check and monitor the sort of data and information needed for accurate calculations with myriads of adjustments. Now, Action 1 becomes relevant for transfer pricing in the context of residual profits that are derived from intangible exploitation and whether they should be allocated as per Amount A. Now, there's not much to say about this topic because a lot of its characterization is still under work in progress. And this basically brings me to the end of the session. Transfer pricing as part of Action 1 on the digital economy and its taxation is, so to speak, under construction. The OECD has invited the public to give input on tax certainty aspects of Amount A under Pillar 1 to address the risks posed to related groups' methodology in assessing their profit allocation under the new rules. And the submission deadline was on the 10th of June this year. We now wait for the outcome. And this is the outcome that's going to provide us with very clear rules and guidelines as to whether there is any impact of Action 1, Pillar 1, Amount A, Amount B, and Pillar 2 on the assessment of transfer pricing. So, ladies and gentlemen, I now want to take this opportunity to thank you for engaging with us. It is my sincere hope that your expectations have been met and there has been an increase in your knowledge